Hi everyone, welcome to the Q2 Carrington webinar. Today I'm joined by Mo, our Head of Investments, and our special guest today is Olivia Micklem from Artemis, who co-manages the US Smaller Companies Fund. As a reminder, please feel free to post any questions in the chat and we can address them at the end. So our last webinar was shortly after Liberation Day. Since then, we've seen quite a lot of volatility and markets have had a strong bounce back, especially from the lows. Coming out of the US, where the epicenter was, where the sell-off originated from. Given what's happened in the US over the last quarter, it's a great time to be joined by Olivia today to provide her expertise in US equities. So Olivia, it'd be great if you could introduce yourself.
Thanks, Lucas. Morning, everybody, or afternoon, actually. I'm always on US time. So my name's Olivia Micklem. I co-manage our US Smaller Companies Fund here at Artemis. I've been working with this team for well over a decade. We joined Artemis about 10 years ago to set up US equities here. We run the Smaller Companies Fund, our US Select Fund, and our US Extended Alpha. As well as co-managing the fund, I also look after the kind of sector coverage for all of our healthcare and consumer staples. So if anyone has any sector specialist questions like that, please feel free to send those over as well. It's obviously been a eventful year so far, a very long 6 months. Look forward to sort of covering off on all the topics you guys would like to run through.
Brilliant, thank you, Olivia. Sorry for the technical difficulties there. I've just sorted out the slides, so anyone tuning in. We'll kick off. So, as I said, we had a eventful start to Q2 where Trump surprised global markets with his so-called reciprocal tariffs, leading markets to plummet quite heavily, with the S&P having its largest two-day decline since World War II. And then he later ended up pausing his reciprocal tariffs to relieve some market stress. Olivia, it would be great if you could give an overview of what's happened within the US over Q2 and explain how some US companies have had to adapt under the new political environment.
Yeah, of course. I mean, what's fascinating is if you had switched off your screens on the 1st of January and opened them today, you'd have thought that the first half of this year had been pretty plain sailing. But obviously that huge rotation we got started at the tail end of Q1 and then was sort of really, came to a head as we got Liberation Day. I think what's interesting when you reflect on this period is I think certainly Q1 was very much a period where everybody was trying to come to terms with what were the real policies that were likely to come out of this administration. And then when we saw those tariff numbers on Liberation Day, I think obviously as we all saw, it was a big shock to everybody, kind of the degree to which they were going after these tariffs. And in many ways, the kind of lack of economic theory that had really gone into some of those decisions. I think what we started to hear was certainly an awful lot of behind the scenes issues amongst the administration themselves. And I think the certainly started with the equity market. And as it leaked into the bond market, the messaging really back to the administration was very much that this is not something that people wanted to see or thought was appropriate. I think you also had an awful lot of very senior corporate executives starting to talk to the administration. And some certainly theorized that the meeting Donald Trump had with the likes of Walmart, Target, and some of the other big retailers was actually also quite a big tipping point, I think, as these retailers sat down and explained the specifics of what was likely to happen in terms of the risk of inflation, the risk of out of stocks, empty shelves. I think it certainly started to lead to that pivot that we then saw only really a few weeks later. It was a pretty rapid turnaround. And that really, I think, precipitated the calming of the markets and then the recovery. I think what's interesting is, as you say, it was a complete, very, very sharp drawdown that we saw, but the recovery has actually been one of the fastest recoveries we've seen in markets. If you look back at each of these market meltdowns that we've seen over the last sort of, multiple decades, really. So I think the appetite for people to buy the dip was very, very strong, particularly in large cap. I would say in small cap, it's been trickier. I think, we can talk a bit more about those dynamics if you'd like, but really with some of the areas around the risk of inflation, what that means for rates, the risk of kind of economic domestic pressure and what that would mean for small cap meant that recovery, whilst it did follow the large caps, it's certainly not been as strong. So as we sit year to date, large caps continue to outperform small caps at this point in the year. I think then the next pivot we had was really taking the focus away from the tariffs. So those discussions and those negotiations started to take place and really shift the focus onto the tax policy and the One Big Beautiful Bill. I do think that's taken a lot of the sort of heat out of the tariff discussion. And, with some back and forths along the way, as we saw, it all got signed and done in time for that 4th of July deadline. that the president had set. So I think what's been interesting there as well is there were certainly debates along the way about what that was going to do to the deficit and the concerns really about those levels. But as we've seen how markets have behaved through that period, it is certainly telling us that the market is actually kind of looking through that deficit risk and that sort of increasing debt in favor of saying, well, this is a bill with an awful lot of domestic stimulus in the form of different tax breaks. And I think you really would expect to start seeing that. You'd really expect to start seeing that come through in 2026 in particular. But you're going to start seeing businesses really start to sort of pivot towards finding those opportunities, whether it's in terms of the R&D opportunities, domestic capex, and that sort of thing. So then the last piece of the equation, I think that's important, that's maybe been missed throughout all of this noise, is some of the parts of the administration's policy that are also very kind of pro-domestic businesses, large and small, and that's really around deregulation. You've started to see it in some of the terms that have been moved around for sort of bank regulation. You are certainly starting to see an increase in M&A appetite, both kind of large businesses buying small and larger businesses kind of merging and acquiring each other. And we do really think that that's likely to accelerate as we move through. If any administration is going to be pro kind of M&A, pro some of these big, corporate deals, it's likely to be this one. And I think that tends to be very good for markets as well. So, a lot's gone on. We've had quite a sort of whipsaw effect, but we're sitting at a point now really where we're looking towards, what's coming next, and really this deadline on Wednesday of the next set of tariff discussions, again, which we can go through in more detail. But yes, it's certainly been a busy quarter, but we've come out of it, with markets in a healthy state. And frankly, the economy is still in a really robust state, as we're seeing in things like the jobs data, the inflation data remaining fairly benign. And so that's a pretty appealing time.
Yeah, thank you. So just taking it back a little bit, when Trump had his reversal over the tariffs, started seeing some stress in the bond market. Do you think investors are thinking there's almost a Trump put there where he can kind of intervene if things do get a bit too nasty?
I think there is certainly that dynamic at play. I think what we're all learning quite quickly is it's very hard to predict how he's going to behave in certain dynamics like this, and who he'll choose to go after and who he won't. As I said, I do think, as you say, the bond market is a pretty strong predictor of how they're going to try, or certainly a strong pushback into what they may or may not do. But at this stage, really, when you think about what the Fed's trying to do, with rates in particular, I do think there's a pretty, strong message that they want to stick to the plan that they have in place. We're now, with that jobs data looking as it was last week, we're really now looking at down to 2 rate cuts, maybe in the autumn. But really, the other thing I think what we need to see is whether there will be an impact on inflation from some of these tariffs as they start to come through. And frankly, at this stage, we don't quite have enough information to know how or where that's going to play out and in which parts of the market. So that's really more, I think, for Q3 and into Q4 dynamic that we'll see, and then we can reevaluate then.
Yeah, it definitely seems like there's a lot of speculation on rate cuts. Trump has been fairly vocal over Fed Chair Powell on Truth Social, calling him things like a major loser, and kind of markets are starting to doubt the Fed independence. How have you seen kind of US companies adapting to these higher for longer rates, and also just the policy uncertainty over interest rates?
Yeah, I think what's interesting, and I think the for longer point is where we need to focus sort of our attention, because really we've had these rates up at these levels for several years now. It's not, the new phenomenon. We're not going through that adjustment phase that corporates had to go through in 2022. A lot of the heavy lifting was done in the tail end of 22 and early 23 in terms of pushing out maturities, hedging out, or fixing floating rate debt. And since then, what we've seen in both large and small businesses is those businesses with robust cash flows have actually been delevering quite nicely. And so you are seeing, I think, where you're able to focus, particularly in small cap, let's say, and the way that we think about the small cap market, that bias towards quality businesses, those with strong margins and cash flows, they can actually cope pretty well in a higher rate environment. And let's not forget the intention of that higher rate environment really is to weed out the weak, to really make sure that those businesses that shouldn't be surviving don't, and leave those businesses behind that are robust, that are cash generative, that can grow profitably. The same is true for large cap. When we speak to businesses about kind of the need for rates to come down, it's not really something that they're particularly focused on. Of course, it would be a nice benefit, and certainly would particularly be a benefit, I think, for the sentiment for small cap. But in the midterm, really, most businesses are sort of have their balance sheets where they want it to be, and frankly, are just sort of happy to continue. I think actually that there's more requirement of certainty around things like tariffs than there necessarily needs to be about the need for rates to come down. Certainly, the narrative from a political level is quite different, but from an actual corporate level, I don't think there's a huge rush or huge need for them to see rates come down. I think we've sort of taken the view that higher for longer is always going to now be the new norm. But that new norm, I think, has now been in place for a couple of years, and I think businesses are in a pretty good position to be able to navigate that from here.
Okay. And then now that Trump has got his one big beautiful bill through the Senate, do you see that having an impact on longer term kind of rates and just in general inflation, and what kind of benefits it might have for US companies and even drawbacks?
Yeah, I think probably less so on the inflationary side. I would say you're likely to see a lot more kind of domestic capex start to come through. You are seeing a lot of these tax breaks in areas sort of like interest deductibility, depreciation schedules, R&D. I think that's all a positive. Now, if you want to walk that through where it might end up, you could potentially say, the demand for domestic labour is likely to go up, and in an environment where obviously immigration policy has got a lot more restrictive, there certainly are questions around wage inflation through that. But then offsetting that, you've got big increases coming through in productivity over time, especially from areas like automation still. You're seeing more and more articles more recently about sort of the acceleration of the likes of Amazon and Walmart in terms of automation in their distribution centers and the use of robotics. That starts to free up labor on the other side. And similarly, just in terms of the AI tools and the productivity enhancements that are coming through from that. So for every area, you might get a little bit of pressure, inflationary pressure potentially. You also have some of these productivity offsets. But I think most importantly, the great thing about having this bill done and then hopefully having some of these tariff questions finally answered in the coming weeks is it actually just allows businesses to actually commit to their plans. I think the biggest disruption we really saw in Q2 and the biggest narrative that came out of the earnings season that started sort of right after Liberation Day were businesses saying it's quite hard to make plans when you're not really sure what the outcome's going to be. So certainly those businesses that were having to embed tariff assumptions in their guidance ranges and that sort of thing were having to do so with a degree of uncertainty, right? That's never great for markets. And I think now that we have sort of part one sort of confirmed in terms of the terms of the bill, those businesses can actually start executing on those capex plans. And so that's really where you'd expect to see, maybe a little bit start to creep in the tail end of this year, but really the big impact, I think, on overall GDP will really start to come through in sort of through next year's earnings. And you are certainly seeing those earnings estimates sort of creep up potentially in the GDP forecasts, creep up for 2026.
Yeah. I know you mentioned the strength of the US economy is still quite fundamentally strong. What do you think the strong kind of market rebound post Liberation Day indicates about the strength of the economy? You said there was a lot of dip buying. Do you think the long-term US exceptionalism story is still there for a lot of investors?
Yeah, I really do. Now, of course, I'm going to say that I'm biased with my appetite for US equities, but we really do think, and we've done a lot of work on this actually in recent months. And one of the things that always comes through very, very consistently about American businesses, whether they're large cap or small cap, is the speed and rate of their growth combined with exceptional free cash flow generation. So the top 50 fastest growing stocks in the US market also tend to have the highest free cash flow margins and the best free cash flow margins and the best free cash flow generation, frankly. And that's very, very unique. And you really don't see that phenomenon in other developed markets. I think when you combine that with the sort of pace of innovation that you continue to see, when you combine it with some of these sort of domestic opportunities you're seeing, this dynamic of deregulation I talked about, and generally when you think about the regulatory environment and what that has enabled certain industries to do, I'm thinking in particular of what the tech industry is capable of doing in the US, it makes for a really exciting opportunity set across the market cap spectrum. And I think, delving down into the small cap space as well, there is a lot of exceptionalism there, particularly in terms of just the growth opportunity. These businesses can remain domestic and still have a huge runway to grow into the market in the US. So we remain sort of really, really confident and really excited about the opportunity set across the market cap range and across different sectors. And I think, I understand, and we're certainly very aware that the uncertainty that was created by this administration has, took the shine, frankly, off the US market. But actually what that gave people was a really great opportunity to buy some of these exceptional businesses at more attractive valuations than we've seen in a while. And I think, whilst uncertainty and volatility is going to remain a feature of markets going forward, whether that's under this administration or others, I think every time you get those opportunities, what it allows you to do is buy these fantastic businesses at something of a discount. And that's a pretty appealing setup, I'd say, for investors.
Yeah. Then we also, during the quarter, there was a bit of a market reaction when the US was getting involved in the Middle East war, dropping their bunker buster bombs on the Iranian nuclear facilities. Do you see the US's involvement in this having major impacts on US equity, or was it just a kind of a bit of noise around equity markets?
Yeah, I think frankly it was a little bit more of the latter. I think really when you see these kind of geopolitical tensions have an impact on markets, it's where there is perceived to be some sort of a persistent structural risk. So what we saw, for example, with Russia and Ukraine was what that did to supply chains, to food supply and inflationary pressures there. Or, if we'd seen some of this Middle East tension deteriorate further or get more widespread, it would be that question about the impact on the oil price. We did obviously see that spike in the oil price, but it settled back down pretty quickly. So whilst it's obviously an incredibly important, series of events from a geopolitical point of view, it's something that the markets kind of digested quite quickly and sort of moved on to what the next news headline might be from a policy point of view.
All right, thank you. So we'll now move on to kind of the Carrington portfolio performance. So given the extreme volatility over the quarter, portfolios held up rather well. All portfolios provided positive returns. So Mo, it'd be good if you give an overview of what happened during this rather eventful quarter.
Yeah, it's a good afternoon, Ron. Thank you very much for joining us today. So as Lucas mentioned, pleased to report that all of the portfolios at Carrington delivered positive returns this quarter. As we've already discussed and mentioned, much of the quarter was spent with the markets recovering from those early falls around from 2nd of April onwards. Given the timing of our last webinar, we did sort of cover that off at that time. And at that point, we were sort of more right in the middle of the volatile period, hadn't quite started the recovery since then. But pleased to report that the markets have recovered very, very quickly, as Olivia mentioned earlier, almost in a straight line up. So clearly, it's been quite a sizable move with very few drawbacks over that time period. So I wouldn't be surprised to see at some point in the near future that some of those gains are given back, but then therefore they're moving forwards thereafter. We hope that the markets continue to recover from this sort of volatile period. If we add up, so just thinking about back to Q1, so most of the portfolios were positive back then as well because of our positioning coming into the year. So that's putting the two quarters together has meant that our year-to-date performance has been very, very good, especially on the relative basis. And we have been pretty active over the 2 quarters. I would say the 2 key areas of focus have been, one, taking profits on the areas that have worked really well for us. So that was particularly through Q1. Just as a reminder, we had delivered some pretty strong performance across the board on a relative basis. And we were quite keen that, we took the view that post-Liberation Day in the big falls that we saw that at some stage, a rebound of sorts would come. And we wanted to ensure that we were able to lock in those gains that we've made and then to participate in the subsequent recovery. So a lot of the activity in the portfolios has been around profit taking and then also trying to take advantage of some of the more sort of attractive valuations. Both of those have worked fairly well. And that's meant that we have not sort of lost ground or anything during the subsequent rally. And the moment everything's sort of working pretty well in the portfolios. In terms of other sort of changes that are going on at the moment, we remain positive on precious metals on a sort of 12-month view. Short term, we have decided to trim back a little bit because gold, for example, the gold prices went up 25% last year, and it's gone up about another 25% this year so far. So that's quite a lot in a short space of time, and we felt that cast your minds back to Q1 last year, where we just doubled the physical gold positions in the portfolios. So clearly that's worked extremely well. We've decided to trim that back and lock in those gains. We expect perhaps some short-term weakness through which we will look to add back to our physical precious metal exposures via a different ETF, which I would have written to you all about previously. I think that's probably a good sort of snapshot of what's happened.
Great, thanks, Matt. Always good to report positive news. So we'll now move on to the 2025 outlook for the rest of the year. So far this year, we've seen a bit of a reallocation of capital coming outside of the US into more kind of global equities such as UK, Europe, and some parts of Asia. I know, Olivia, we touched on this briefly before. US exceptionalism now under threat. How do you see kind of other regions taking capital allocations out of the US, or do you think it's just a matter of waiting to go back into the US? I know the US now equates for about 73% of the MSCI World Index. Do you see that staying at around that level, or eventually it might have to retreat backwards a little bit?
Do you know, it's a tough question, to be honest. I mean, from my point of view, I still see so many opportunities within the US market that would suggest that you can keep those allocations at that point. But obviously, you know, everyone's been looking for broadening, not just in the US market, but globally as well. The tricky thing is for every moment that everybody wants to sort of broaden things out, there's suddenly another opportunity in the US that looks really appealing. So, you know, that sort of balance in terms of asset allocation is always going to be tricky. But I do think, you know, that sort of level of allocation to the US is going to remain really important moving forward. And certainly I do think, and when you look at sort of earnings forecasts, particularly for next year, you are really seeing as well a broadening out in the US market, the kind of growth you're seeing outside of the Mag 7. And I do think that certainly helps support another reason to stay in the US, right? I think what's been tricky till, you know, in the most recent periods, the last few years, is that dominance of the Mag 7 has obviously made, you know, how you allocate to the US a little bit trickier and a little bit more complex in terms of that concentration. I think as you get that broadening out, across large cap, I think that helps support a reason to remain allocated at those sort of levels. But I would also argue you're starting to see that broadening into small cap as well. Now, we had one wave of that in the latter half of last year, and particularly post-election as the Russell really started to work, you know, and perform a lot more strongly. That's obviously taken a pause, but I think can really reaccelerate. And when you look at the valuation of small cap relative to large, the kind of attributes you can get in parts of small cap, and also when you look at that relative to other developed markets, I mean, the opportunity, the total market cap of potential businesses in that sub 10 billion bucket is as large as the entire European equity market. So there's still a lot of opportunities, I think, for allocations to perhaps improve there. So I think, you know, looking forward, I think you can still continue to see the allocation to the US remain that high. Perhaps the way that it's allocated across particular stock sectors or market caps might change. You know, there are undoubtedly some great opportunities in other markets as well. So there certainly is a reason to sort of broaden that out. But I think one of the tricky things is just given the size and the market cap you've got in the US, it's quite hard to move a lot of that into other markets without having a sort of distorting effect overall.
Yes. Yeah, I feel like the Mag 7 has definitely taken a lot of the limelight over the AI story over the last 2 years. And obviously in Q1, you had the release of DeepSeek, now has a kind of a bit of competition to US AI dominance. With this kind of broadened out of sectors, how do you see the Stargate program impacting that? I know Trump is kind of trying to reignite the US AI sector by trying to fend off some competition from China, implement, I think it was about 500 billion of investment. I don't know what the time frame was, but he really wants to kind of lead the race in that.
Yeah, and I think a lot of what you've seen as well in some of the kind of trade war discussions and the dynamics and the restrictions being put on certain sectors is another part of that, right? So it's sort of trying to kind of gatekeep some of this technology. I think ultimately, whichever way you kind of want to work out who will or won't win, I think the reality is the ability to really build these models requires these huge semiconductor stacks, right? So there's no way around that. And in spite of great progress being made by some of the competitors, what you get from NVIDIA is by far the best. So that remains the case, and it remains the case, you know, for all of the success that we saw from DeepSeek. what they had done was very much built on existing capacity. That when they talked about how cheap it was for them to run DeepSeek, it really didn't take into account some of the capex that had gone in behind that. And so whilst the hyperscalers continue to spend sort of, eye-watering sums of money in some cases on this capex, it remains to be the way that you lead. You have to have that stack. You have to have that infrastructure to be able to build these models. There's a lot of talk about what comes next, whether it's the next wave of AI being in the AGI side of things. What remains to be seen kind of when that will come. But really where we are now as well is in that phase of trying to see who can and can't monetize this information, right? So these the use of ChatGPT in terms of everyone's day-to-day productivity might be great, but who's really had the success in monetizing? So far, it has really been Meta. It's Meta's ability to use that investment that they've made and start to monetize that from an advertising point of view. You're now sort of thinking about what it's going to do to search and the risks of things like Google. So we're still in that, such early stages, but increasingly though, businesses have been working out how to use what is available to them, whether it's sort of Microsoft tools, ChatGPT or other products to rather start to improve their productivity. When you think of it in global terms, really a lot of that as well is about security. So I certainly think what we're seeing probably in government spending, what's going on from a defense point of view is going to be really important, and really making sure that the US retains that leadership when they consider that relative to other markets. But, it's sort of still pretty open playing field for everybody. And I think the opportunity set that's still ahead of us is really, really exciting. And I think people are starting to, we would like to think starting to get more comfortable that these spending levels are the right thing to do. This isn't just a bubble, and the kind of valuations that that's supporting are actually probably still quite attractive, even in names like Nvidia.
And how do you see the dollar impacting international investment? Obviously, the dollar index was down about 7% during Q2. Kind of naturally, in times of stress, it's just a safe haven asset. Do you see kind of dollar weakness having any impact over foreign investment?
It's an interesting one. You sort of would have expected maybe to see, some more of that start to play out. We haven't just yet. I think what's interesting from a corporate point of view is that the weakening dollar was actually quite a useful opportunity for them to be able to, certainly for international companies, to actually offset some of the tariff headwinds in their guidance with obviously FX benefits. So you've had some of that playing out. In terms of foreign investment, we'll see. But I think what's almost more exciting right now is the amount of opportunity being afforded as a result of the tax bill and everything else for just domestic investment to continue to drive the economy. Foreign investment continues obviously to be an important component of that, but when you've got this acceleration in domestic investment, it becomes less of a concern. I think, in terms of kind of what the dollar does from here, we'll see. I think some of the narrative around tariffs that are going to come out in the next, whether the next few days or next few weeks, I think will be an important component of that. I think once all this sort of is resolved, as I said before, kind of this uncertainty dynamic settles down, I think that gives some nice support to the dollar moving forward. It's sort of unlikely that you'd see that pressure, I think, persist for much longer.
Yeah. And then just on the uncertainty part, obviously Trump has this image of getting a lot of companies away from the likes of China to relocate into the US. There's a lot of uncertainty if companies were to make that move, and then also the fact if they're going to build a new plant, a lot of the machinery they're going to have to buy is probably from China. How dependent is the US on China really, and how do you see that relationship playing out as there is a lot of uncertainty there at the moment?
Yeah, I think one of the first things I think is always, important kind of to root the discussion is remembering how much of the economy in the US is services led rather than goods led. And so once you've got that dynamic in place, I think it's an important sort of important part of the discussion in terms of what comes next. But you're right, obviously on the good side, a huge amount is still sourced from China. But actually, if you look at that relative to, say, kind of pre-pandemic, it has been going down. And one of the things the pandemic certainly did for businesses was highlight the fragility of their supply chains being overly reliant on one particular market. And you've seen a lot of companies that were super reliant on a Chinese supply chain actually diversify away from that, whether that's obviously into Latin America or other Southeast Asian countries. And so that's been a part of the equation for sure. Ultimately, it's always going to be, a component of everyone's supply chain. You're not going to get away from that. And I think increasingly the administration is acknowledges and understands that. I think so long as they can have either, whether it's control the narrative, get the headlines. I mean, this is a president for whom headlines sometimes matters more than the realities. And we certainly even saw that in the tweet last night or this morning, or the Truth Social post around, the BRICS warning shot. if anyone treats us, in an anti-American way, you're going to be subject to higher tariffs. A lot of that is just sort of narrative and posturing. Businesses know that they need to rely on parts of the Chinese supply chain, and that will always continue to be the case. But I think the sort of specifics of it and the single reliance on it has certainly improved over the years as companies have done more diversification on that front.
Okay, thanks for that. We'll now bring in Mo. It'd be good to kind of hear your thoughts on global macro expectations regarding kind of inflation. There's been a lot of speculation of higher inflation down the line. CPIs tend to be tending up a little bit. How do you see things unfolding for the rest of the year?
Well, I think the very first point to mention is, and I think again it's already been said, is that there's a great deal of uncertainty in terms of what the US administration is going to do. And so that, I think, makes any predictions quite difficult to make at this point in time. Yeah, the likelihood is at the moment that inflation may remain at sort of levels that they are at the moment, and that may well mean that interest rate policy largely remains the same as well. We may get a few interest rate cuts over in the US. And here, clearly in Europe, they've come down more meaningfully, but it's very, very difficult to make a call on any one of those areas. And so I suppose just trying to think more about the actual portfolios themselves in that scenario, what we're trying to do is try to be as diverse as possible, whether that's by geography or other factors. So again, I've mentioned this in the past, and we continue to talk about the benefits of trying to be as diversified as possible. So whilst we still have a very healthy allocation to US equities and have had for the past couple of years, we've tried to ensure that we have good allocations to other regions and have been fairly overweight areas such as the UK and China to try and offset what we view as momentum in the market. So clearly there's been a lot of momentum behind US markets and others, such as Japan, for a couple of years. And whilst we want to participate in that clearly to ensure that we deliver good outcomes for clients, we also are mindful of periods of time, such as we saw this year, when that momentum is not necessarily working for you. And so the other parts of the portfolios have worked extremely well in that situation, which is why we've done quite well this year in trying to offset or mitigate against those sort of changes in momentum. So yeah, very difficult on the macro side to try and make any sort of clear-cut calls. But I think what it does say is that we need to maintain our diversification in portfolios. And actually, I suppose another thing that we've been different this year to last year is that we've been much more active. And I think that's going to be probably a feature in the next sort of 6 to 12 months plus, that we do think that we are going to be more sort of prone to volatile periods in the markets. And that will require a greater degree of active management as and when we see other areas where we need to trim back, or if opportunities arise, then we can try and take advantage.
Great. Thank you, Mo. So we'll now move on to the Q&A section. Got a question for you, Olivia. So is the US consumer fragile due to most of US household wealth tied up into the US stock market?
It's a good question. I think to some extent, yes. But alongside that investment in the market, you've also got a huge amount of wealth tied up in homes, and home price appreciation has remained very strong. And frankly, a lot of people still holding on to these 30-year fixed rate mortgages that was sort of set at kind of much lower levels than we are now. So there's that expectation that you have that dynamic as well. I think it's very different when you think about it by income cohort, though. So what we're really talking about with the sort of wealth effect from homes and the market is much more of a middle to high income consumer dynamic, and they are in very good health overall. Savings, we went through the cycle of building savings and depleting through the pandemic, and now they're pretty steady again. They're very well employed. They've had wage growth. There's still opportunities employment opportunities that continue to build. So I think that side of it's very healthy. The low-income consumers is in a slightly different place. They don't have that wealth effect dynamic to the same extent. Now, they have got pretty full employment as well and have had the wage growth, but they've seen far more of their paycheck month to month still be eaten up by inflation, particularly in things like food and basic goods. So that part of the market is the one that probably needs a little bit of a relief, whether that comes from lower rates or comes from kind of a rolling of inflation. We're certainly starting to hear more of the CPG companies understand that they need to start doing more in terms of promotion, and Walmart's talked a lot about this, the importance of these rollbacks and trying to deliver value back to the consumer after a pretty heavy period of inflation of the sort of daily basket. So the fragility, I think, is probably more a function of, if we saw a significant change in, say, employment, I would worry more about that than necessarily the market dynamic. And indeed, we have seen a lot more retail activity in terms of the retail investors and that influence on the market. And I do think that was probably a component of that acceleration we saw coming out of the pullback in April, was sort of how active some of the retail buyers were in the US, trying to take advantage of those same opportunities.
Okay. And I know you've got a bit of experience in the US healthcare sector, and Trump's been quite vocal of getting lower drug prices and getting rid of the likes of Obamacare. What do you see kind of happening in the healthcare sector? Obviously, it's been a fairly kind of unloved area of the market. Do you see more upside there?
I think there's a lot of really interesting opportunities. When you look at, you're in situations where some of the companies that actually have the best free cash flow margins in healthcare also are now trading at the highest free cash flow yields. It's quite an unusual dynamic. The kind of controversies around certain sectors are kind of at an all-time high, with the exception of medtech, which has performed very, very well. Pretty much every other sector in healthcare has really, really struggled, whether that's about regulatory concern, policy concern. You still have areas and things like life sciences still recovering from kind of post-pandemic disruptions, and now concerns about whether it's funding for academic spending and NIH. So there's a lot of headwinds all kind of together. And then to your point about kind of drug pricing as well, I think what's important to always remember is the inherent complexity of the US healthcare system makes these kind of changes very, very difficult to achieve over time. And what you are seeing certainly on the drug pricing side of it is, again, I think a lot of rhetoric and a lot of headlines and posturing that may not actually have meaningful impacts to what you're likely to see. Now, whether they can maybe close the gap in some areas relative to other countries and the prices paid, that could happen over time, but it's a pretty complex thing to be able to unpick when you're trying to deal with commercial pricing, government pricing, individual cash pay. It's a pretty complex market, and I think that makes these kind of changes happen very, very slowly. What it means from an investment point of view is it gives you some really exciting opportunities, right? Businesses that we think have incredible kind of long-term opportunities, great cash flow profile, great returns. You're starting to sort of see them at very, very interesting discounts. The tricky bit, obviously, is the unknown piece of how you time those kind of policy shifts, or certainly when the dust will settle and the policy kind of moves into the rear window. So we're not sort of necessarily trying to get those timings perfect, because we don't really know, but it certainly offers up opportunities for businesses that we think of, these very fantastic long-term compounding type businesses with these great return profiles that are currently in a sort of throw the baby out with the bathwater dynamic as each of these headlines hits over and over again for the healthcare sector.
Okay. Brilliant. I think we'll wrap things up there. So thank you everyone for joining. Thank you, Olivia, for being our special guest. It's been really good listening to your insights into US markets. I'm sure everyone would appreciate that as well. So feel free if anyone wants to send follow-up questions, or if not, I hope you will have a good week, and we'll see you for Q3 webinar in 3 months. So cheers everyone.
Thanks, Olivia. Thank you, everyone.
Thanks for having me. Bye-bye.